So today's bit of real estate development jargon is the cap rate. It's something you'll hear about often when real estate deals are being discussed, transactions, or development. Cap rate has a simple definition, but huge implications on a project. Cap rate is defined as the net operating income, NOI, divided by the value of the project or the asset. So cap rate is net operating income divided by the value. And net operating income, and I can link to my other video on NOI, but net operating income is simply the operating revenue minus the expense. So cap rate is NOI divided by value. That means it's inversely related or inversely proportional. Cap rate and value are inversely related. So if the cap rate goes up, and a cap rate is a percentage value, if the cap rate goes up, if assuming that the NOI for the project stays the same, that means the value of the property goes down. And if the cap rate goes down, the value of the property goes up. So counterintuitively, cap rates going down, if you're the owner or the investor, is a good thing. If you're trying to purchase properties, cap rates going down can be a challenge because the value of what you're trying to buy and the amount of NOI you're receiving in exchange for your purchase price is going down. And so really what cap rates have to do with is an easier and a more simplified way for investors and owners to compare values of deals because you can compare the price, but that doesn't really tell you much, right? You could have a $1 million project that is highly profitable, or you could have a $100 million project that is not making very much money. The value doesn't tell you how good of an investment that property is. And it also doesn't tell you the level of risk because if you have two similar projects that are in different markets that have different amounts of risk, let's say you've got a tower in market A and a tower in market B. Market B is growing, rents are growing, and lots of people are moving to that market. So there's a lot of demand for that space. The other tower, not so much. People are leaving town, there's lower demand. So you could have the same exact building that have very different values because the risk associated with those two projects is different, and that is reflected in the cap rate. So again, you could have identical buildings with different cap rates, meaning that the value of both of those properties is going to be different, even if in all physical terms they're identical. So a cap rate allows investors to understand the risk of a project, the risk profile of a project, and the value that they're getting for that investment dollar. Because really, what an investor is looking for is they're buying net operating income. And if they can invest, if you have, let's say, $10 million to invest, and you have either a $10 million project that you can buy at a 10% cap rate or 10 $1 million projects that you can buy each at a 10% cap rate, that means you'll invest your total $10 million by $10 million worth of property and at a 10% cap rate. By doing the math of the equation, you find that the net operating income for that portfolio or single asset is going to be $1 million a year. And so that's what you're buying. You're not buying the build, you are buying the building, but what you're really buying is net operating income. That's what the investor is looking for. So cap rate is really just a simplified way of understanding risk and understanding the amount of cash flow or net operating income that the investment is going to return to the investor. So again, cap rate is net operating income, which is operating revenues minus expenses divided by the value of the property. If cap rates are going up and the NOI stays the same, values are going down. If value or cap rates are going down and NOI stays the same, values are going up. They travel in opposite directions. If you have any questions, please let me know. I'm happy to explain further.